Palantir says it can 10x revenue while cutting headcount. That's not software, that's financial Ozempic. But can this company actually climb to a 1 trillion valuation without getting altitude sickness along the way? Let's take a deeper look. From dump trucks to doctors' charts. Guys, my name is Dr. StopLoss here on YouTube. I'm a former garbage collector turned doctor psychiatrist, and I've been trading in the stock and options markets for the last 8 years, so I know irrational behavior when I see it. The goal of this channel is simple. It's to give you clarity in the markets, help you build a profitable skill set, and show you how finance can actually be the boat that takes you where you want to go in life. Quick reminder, I'm just your average doctor with a mic. I'm not your fiduciary. This is infotainment, not investment advice. Please trade responsibly unless you think diversification means holding 5 different flavors of ramen in the pantry. Then I guess you're going to end up in the same place either way. So let's get into it. Today we're breaking down both sides of Palantir's $1 trillion dream. On the bull side, a $1 billion quarter, a rule of 40 score of 94, which is unheard of, and a 10-year Army contract with a ceiling of up to 10 billion. On the other side, a 69 times sales multiple that has short sellers circling like vultures. I'll show you the math it would take for Palantir to actually reach 1 trillion, the gotchas that could derail the run, and where the trade might make sense. Let's start with one of the main engines that's powering Palantir right now. It's known as AIP, or also stands for Artificial Intelligence Platform, and it's a software framework that integrates large language models with an organization's data and operations to create secure operational AI applications and autonomous AI agents. Obviously, I didn't have to look that up. In Q2, Palantir reported revenue of $1 billion, up 48% year over year, with U.S. revenue jumping up to 68% and U.S. commercial up a staggering 93% to $306 million. This pushed their Rule of 40 score to 94. And just to give you a little details on what the Rule of 40 score means, it says that if a SaaS company has revenue growth plus their EBITDA, EBITDA, earnings before interest, taxes, depreciation, and amortization margin, or free cash flow equaling over 40. This is a great thing. It's a very healthy SaaS company. Management even raised full year guidance to about $4 to $4.15 billion for the coming year. Free cash flow guidance is now in the range of $1.8 to $2 billion. So yes, this is starting to look like a cash machine. What has the bulls excited is how AIP is collapsing the sales cycles. Just to give an example, a healthcare company recently signed an $88 million deal within just months of adopting AIP. That kind of turnaround is unheard of in enterprise software, and so Palantir is showing that boot camps and quick proofs of concept can rapidly turn into multi-million dollar contracts. This isn't your typical SaaS, this is swole as a service. Swole. Now let's talk about the moat. Defense has always been in Palantir's DNA, and their 10-year enterprise agreement with the U.S. Army proves it. The contract has a ceiling of up to $10 billion, consolidating 75 smaller contracts into one streamlined pipeline. In practice, this means Palantir is now the pre-approved vendor with the fast lane pass at the Pentagon. But remember, a ceiling is not guaranteed revenue, it just sets the maximum. How much of that ceiling turns into real returns will be crucial. But as we climb the 1 trillion market cap Everest here, we come to the oxygen problem, which is Palantir's valuation. Palantir currently trades at around 69 times trailing 12-month sales. Compare that to Cloudflare, 36 times, Snowflake at 17 times, Datadog at 15 times, and C3 AI at just 6 times. If you consider these competitors in the space, which is also a difficult case in itself to make, do these even compare to Palantir, really? Even fans admit this is nosebleed territory, dangerous times. And we've already seen what happens when sentiment shifts. The stock ripped to all new highs, then recently dropped 17% with Andrew Left of Citron Research calling the valuation absurd. Short interest now sits at 54.7 million shares, or 2% of the float. Add in that CEO, Alex Karp, recently sold 409,000 shares. Even if it was tax related, headlines spooked retail, and now You gotta set up where momentum cuts both ways. At this altitude, even one stumble in growth could cause the multiple to compress quickly. So, what would it take to actually reach a $1 trillion valuation? Right now, Palantir's market cap is at about $433 billion. To get to 1 trillion, the company needs to roughly 2.3x from here. In a base case, assuming revenue compounds at about 40% annually over the next 5 years, reaching 22 billion if the market is still willing to pay 25 times sales, that gets you to an enterprise value of about 550 billion, short of 1 trillion. In a more aggressive case, assume 50% growth, taking revenue to about $31 billion. If the market pays 30 to 35 times sales, you're in the ballpark of 930 billion to 1.1 trillion. And finally, the cart mode case, 58% CAGR, basically 10 times revenue in 5 years, combined with free cash flow margins ramping up towards 45 to 50%. That's the scenario where you can mathematically justify a $1 trillion valuation. But that is perfection pricing, and perfection is rare, guys. Even under hyperbole assumptions, a plain DCF model or discounted cash flow model values Palantir under 90 a share compared to the $180 plus it trades at today. That means the market is already paying upfront for years of 50% plus growth and elite margins. So what could actually get Palantir there? Real returns from the Army deal and other DoD or intelligence contracts? Not just ceiling headlines. More commercial wins above 50 million like the healthcare example I gave earlier. And of course, narrative fuel. If analysts start dropping 180 to 200 price targets, and maybe even further than that, and continue calling Palantir the Messi of AI, like Dan Ives suggested, that keeps institutions hooked. Bottom line, Palantir doesn't just want to be a player, it wants to be the platform. At $180 a share and nearly $433 billion in market cap, the street is already pricing in hypergrowth. So let's talk about the lesson for this one. Valuation isn't just math, it's mood. Retail enthusiasm and institutional endorsements can keep multiples elevated far longer than models suggest. But when the mood shifts, especially in these type of hypergrowth companies, the drop is brutal. In other words, markets are powered by psychology just as much as spreadsheets. If you're trading Palantir, you're betting on both. Hey everybody, if you want more market insight like this, then please smash the like button 1 trillion times for me and make sure you end on an odd number. It really helps. Drop your prediction for what year Palantir hits 1 trillion in the comments. And hey guys, make sure you subscribe if you want me to sanity check the next hype train before the ramen goes cold. And one last thing, we all know Carp's hair is legendary and wizard-like, but what about Jensen's Nvidia jacket or Lisa's AMD swagger? If you want the full body of AI investing and more analysis, then click the linked videos here. Otherwise, you're just skipping leg day. Appreciate you guys, and I'll catch you in the next one.